US data has been a cause for concern this week, yet US stocks are rising for a second straight week with the S&P 500 back above 6,000. Meanwhile, the US dollar is pretty much flat on the week, but still below the psychological 100 level versus a basket of currencies. I'm Fiona Cincotta at StoneX, and I'm joined today by Head of Global Content, John Kicklighter. Thank you for joining us, John.
Thanks for having me.
So what are the general market conditions we should expect to deal with next week?
So as you can see, there's a lot of headline activity, but I don't think we have exactly the same amount of market-based volatility to link up to what we would expect. And this is going to, I think, give a lot of traders some discomfort in how they should approach the markets. I think we will continue to see a lot of headlines. It's just a very headline-oriented market, and that could give us some unexpected, impromptu bouts of volatility. Still, given the circumstances of where we're at, we are in the seasonal downshift into summer doldrums for the Northern Hemisphere, which has a lot of expectation around it. And that is going to really draw upon that sense of complacency and an expectation where investors stick to their buy and hold strategies. They stick to a yield earning capacity, and they're not really expecting those swings in trades and those opportunities that usually come with it for the active trader. But these types of circumstances can turn very quickly. And when you have thinner liquidity, thinner volume because of those expectations, you can see very abrupt, very significant bouts of volatility. So you have to remain on your guard. And especially when you're this close to record highs and benchmark assets like the S&P 500 and other indices, it's going to be a disproportionate balance.
So what are the most potent themes that could upend the market for the bulls or the bears?
So going forward, I do think you just have to be cautious about how you prioritize. We do have some very significant scheduled macro-based event risk. We're going to be touching upon growth and inflation. We are preceding the week of a strong run of major central bank rate decisions, including the FOMC with this updated growth forecasts, which will be very important, especially with the context of the market today. But you just cannot take your eyes off these headlines. That makes for very difficult trading, I think, for a lot of traders. They like to see a known quantity, a scheduled event, plan for it, see the scenarios, lay out their approach to the markets dependent upon what the scenarios are. And that's just not the kind of conditions that we have. So headlines, especially around themes of what the focus of the U.S. president is. It seems to be a constant. Trade wars is still a very important element, but the fallout between the president and previous Doge head Elon Musk is going to definitely continue to be very sensitive. We did hear yesterday, or we saw in tweets, that Musk said the U.S. is looking at a recession in the second half of the year because of tariffs. So bringing that trade war consideration back to the forefront, but also talking about the budget. We've seen that as a theme go in and out of popularity, not really holding the total sway of the market because there's just an abundance of distractions nowadays. But that could very readily come back as a dollar off or anti-U.S. trade has been a factor in why that dollar is so low. And that could, again, be a top theme. And all of this knowing that we will have these definitive events along the way, like a FOMC rate decision, just not this coming week, the week after.
So what is the top event risk next week that could spur these themes or kick off a new focus?
So as it has been the case over the past couple of weeks, we need to look at this event risk with the context of what's going on thematically and which of these major themes is important, market moving, or really dominating financial headlines. And there I can touch off a tidal wave of interest and market adjustment. So you can look at some fairly mundane things that show total influence, and that'd be completely unexpected without context if you were looking at it historically, like you were 2 years in the future legislature look back and say, why in the world did that indicator actually move the market that much? It historically doesn't have that capacity. It's all about context nowadays. So Monday, I will be watching two indicators, really. The Chinese trade balance, for obvious reasons. It's going to be a place setter, a level set for expectations of where we're going to go forward. We also have the U.S. inflation expectations figure, which is going to precede the CPI, which is later in the week. That is the key indicator. The dual mandate for the Fed is to balance inflation and unemployment. We had Donald Trump pressuring Jerome Powell to cut rates. He said today they should cut it by 100 basis points or what percent. And it really won't happen unless that dual mandate is really pressured. And that inflation figure right now is still keeping the Fed constant. So that inflation expectations has a little bit more weight. Tuesday, we're going to get into some sentiment themes, some growth-oriented activity. I'll be watching, Australia has some business and consumer confidence reports. I will be watching the US NFIB business optimism indicator. Not normally a major market mover in and of itself, but we are looking desperately for all insights into what the American business and consumer and manufacturer is feeling and how they expect to spend, hire, and just be active going forward. So these become a little bit more interesting indicators. We also have UK employment for so European volatility there. Wednesday is fairly light with just two things that I'll be watching. Maybe Japanese factory level inflation, because the BOJ rate decision is next week, early next week, but it's really that US CPI. That's going to be a focal point. I'm sure the US president's going to be focused on it as well, and we'll spin it however it comes out. But the markets are going to read one thing, the president's going to read another thing. It will touch off headlines, certainly worth watching. Thursday, we get into a mix of data. We have the factory level inflation indicator for the US, so that's going to be building off of that CPI the previous day. You have UK, a run of data like the GDP, the trade, the industrial production figures, certainly noteworthy for the European session. And then Friday, I'd be looking at you could watch the Chinese and maybe Canadian autos. There's a few auto measures this week, but it's really the context again. The expectation of trade wars, steel and aluminum tariffs, how these Tesla is being focused on by the U.S. government now. This is really going to make the auto industry much more interesting, especially in a global context. But I will be focusing mostly on the U.S. Consumer Confidence Report from the University of Michigan. If you recall, a lot of disparity between the U of M and the Conference Board, and a concerning outlook for the U.S. consumer. We would thought it would bounce back significantly, but it has not from all the trade war back and forth. So we want to see, is that a trend that continues? Because the U.S. consumer is really an engine of growth for the entire globe. Its consumption is massive. So where its expectations go, so too can global growth.
Excellent. Well, thank you so much for highlighting what to be watching out for next week. Great to have you back on the show, John.
Thank you.
For more videos like this, please do like and subscribe.